We are watching markets this morning. The Dow and S&P 500 both less than 1% from their all-time highs, and futures are up across the board. 24-point gain on the Dow futures right now, and we're seeing it. There's been a sell-off in Treasuries. The yield on the 10-year hovering above that 3% mark. That's a 4-month high. Joining us now is Merrill Lynch and U.S. Trust fixed income strategist Matt Diczok. Matt, what do you make of this about finally we're getting a little bit of the steepening of the yield curve where those longer-term interest rates have gone up? Is that a positive sign? Because people always talk about the inversion of it, where shorter-term rates are higher, is a sign of economic weakness ahead.
Yes, so it is a positive sign that long-term rates are moving up slightly. What that tells you is the market is basically on board with what the Fed's policy is going to be for the next couple of meetings. So the Fed said they're going to hike probably September, probably December. The Fed's forecasting 3 hikes next year. The market's a little bit less optimistic. The market agrees with the Fed for the next couple of hikes. It was a little bit unclear next year. They had them at 1 hike. But now as the rates move up, the market is saying more and more they're comfortable with the Fed's policy. As long as the 10-year rate continues to move up in this range, we think we're in a good place right now.
I was surprised that the market overreacted the first time we came up near 3% yield on the 10-year. Market sold off. But now I think the market understands that if the rates are rising for the right reasons, it's okay. So if we get 3 rate hikes next year, I think as long as it's supported by an improving economy, the market can continue to go quite a bit higher.
I think that's absolutely right. So Dick had mentioned that the flattening of the yield curve, right, 2s, 10s would come down to about 20 basis points or so. That had concerned a lot of investors, but we don't think it should be a concern for investors. Right? The important thing to look at is either 3-month to 10 years or Fed funds to the 2-year spread. Right now, there's about 90 basis points between the Fed funds rate and the 2-year rate. That tells you the market thinks that another 2 to 3 hikes from the Fed is okay. They're not concerned about it. What you would be concerned about would be an inversion. Right? 10-year rates substantially below 2-year rates for an extended period of time, or 2-year rates below the Fed funds rate. An inversion would tell you that the market thinks the Fed is too restrictive and going to make a mistake. We're not close to that.
Is overshooting is going to whack the economy, even send the economy into a recession because people are buying those longer-term bonds as protection if there's an economic downturn.
Are you surprised?
I hope I got that right.
Absolutely.
It's before 6:30 in the morning.
We don't think economic growth doesn't die because of old age, right? It dies because of a Fed-induced recession to try to keep inflation down.
Right. Were you surprised by the reception of that $15 billion bond deal from Thomson Reuters? All this junk bonds, C-rated, double C, just they gobbled it. Markets gobbled it up. There's a huge appetite for it.
So there still is a lot of appetite. Given how strong the economy is, both investment grade and corporate bond markets are very receptive to new issuers. And in particular, as you saw in that, there was a lot of loans in that when there usually would be a combination of bonds and loans. So there has been a lot of flows into the loan space. We think for the foreseeable future, as long as the economy continues to do well, that market will be fine. But as we look farther out, 2020 and further on, as we think about the next recession, I think the turning of the next credit cycle will be interesting because we've seen a lot more leverage in corporate bonds. We've seen a lot more issuance in the BBB space. We've seen a lot more in leverage loans.
Covenants on these bonds were non-existent.
Covenant loans are a lot less right now. So
interesting, by the way, from a fixed income investor is really... I mean, that's a way of saying it could end really badly in terms of these kind of riskier areas of fixed income market.
What I would say is, if you think about leveraged loans as an asset class, and that's one of the questions I think you were getting at. Historically, you've got about 80 cents back on the dollar when those loans defaulted. Given more leverage in the system now in terms of how much we're lending to companies, given the covenant quality you talked about, the money you're going to get back when these loans default and the credit cycle turns is probably less than that, somewhere in the 60 to 70 cents range. So if you're just going on historical losses on leveraged loans and high yield, you probably need to bring that down a little bit. So we particularly are underweight high yield, underweight leveraged loans at the moment. Not as underweight as we could be because the economy was strong and it should continue to do well as long as the economy continues. But when the credit cycle turns, you can expect greater credit losses on these instruments, and investors need to think about that and need to think about owning to term of what they're investing in.
And do you fear that the Fed is going to try to stop this economic expansion on the idea that we're all overheating because we're doing so well?
So it's a very important question. It's the key question, Steve. So if
they have no business doing it, but that's not going to stop them.
That won't stop them for sure. If you listen to Mr. Powell at Jackson Hole, He gave a good speech, which was more philosophical than specifically about the data, and he was very patient. He referred to Alan Greenspan being patient, even though the data might have told you otherwise, and at the time he thought he was right because productivity increased. He will take it meeting to meeting. He will not do too much, so I don't get any sense that they're worried. He even said even though the labor market is below 4% and the Fed's longer-term forecast is 4.5%, does not see overheating because inflation has not come up yet. So as long as inflation is in check around 2%, I think they're going to be inclined to let it run a little bit longer.
Matt, thank you so much. That was great insight. Matt Diczok from Merrill Lynch U.S. Trust.